Hey everybody, Jason Seibel here. Hope you're doing awesome. Just want to reach out to you today because I've had so many people call, email, text, and ask me what's the story with the 2017 Tax Cuts and Jobs Act and how's that going to impact housing. So I figured I'd put together a quick video and share some of the key drivers and how that's going to impact 2018. So I've got four. We'll start out with number one. First one is the primary residence exclusion. The current rule was if you lived in a residence 2 of the previous 5 years, you could sell and cash out up to $250,000 as a single individual, $500,000 as a married individual. And the proposed rule was going to take that to 5 out of 8 years, which would have been a big loss. But when all was said and done, that rule stayed put. So you could still sell in 2 years and capitalize $250,000 to $500,000, depending if you're married or single, which is awesome. Number two, mortgage interest. There was huge fear in the marketplace. The current rule is any loan balance of $1 million, you could write off the mortgage interest as well as on second homes. The proposal said that they were going to take that down to $500,000 and primary residence only. Where they ended up was right in the middle. $750,000 loan balance, you can write off the mortgage interest, but the biggest piece is they left second homes alone. So that's included a primary residence and a second home, which is again fantastic. Some of the things that did not work out quite in the favor, state and local taxes now have a $10,000 cap. So that's property taxes and what you pay in state income tax. And if you get over that number, it's no longer deductible. So that will absolutely have an impact on our home buyers this year. Standard deduction is driver number 4. The standard deduction is currently set at $6,000 for single individuals, $12,000 for married or filing jointly. That number is going to double to 12 and 24. So what this means is there's less incentive from a tax perspective because it's going to be harder to get to that standard deduction. You're not going to get the write-off like you would. Now, you still get it to some degree, but not specifically for the house. So they're estimating 90% of all people will not be able to itemize anymore, which is a huge number relative to what it is today. So in summary, all in all, things aren't too bad. The opportunity cost for a first-time buyer in the Portland market last year, if you figure in price appreciation, principal reduction, and tax advantage, if somebody rented versus bought, it was about $20,000 a year. With the new tax law, it takes it down to about $15,000 a year. But at the end of the day, it's still a great time to buy because $15,000 a year in asset accumulation is better than zero. If you have questions, reach out to me. Let me know how I can help, and all the best.